Welcome back to the monthly market call that I do in partnership with Real Estate Magazine. Thanks a lot for all of you joining. I'm going to cover a bunch of stuff today. I'm going to start with the Ontario Bill 60. I thought it'd be an interesting insight on kind of like what's going on in the landlord and tenant space. And it's gotten a lot of media attention. And so I just sort of wanted to explore it a little bit. We put together some data on past tribunal cases, and I just wanted to get to the bottom of whether or not there is actually an issue with the Landlord and Tenant Board and whether or not the claims of a lot of the protesters. I guess we saw a lot of protesting on this bill over the weekend. I'm going to cover mortgages. I'm going to cover unemployment and inflation as I do every month. All right. So the Ontario passed Bill 60, which had a bunch of protests. This is just a headline from CTV News. There was a protester over the weekend for National Housing Day, and then there was protesters actually like in the gallery. It was interesting, I guess, but Doug Ford told them to go get a job. So I really just wanted to like zoom in on what's happening with the board because they publish annual tribunal data. So we went back and aggregated all of the data from the Landlord and Tenant Board and put together these charts. So by and large, landlords are the largest applicants of the Landlord and Tenant Board. They do now it's about 6 times the number of applications that tenants do. So you can see here, landlords, obviously, it dropped off during COVID because the courts were closed, et cetera. But generally, the larger user of the court system for the Landlord and Tenant Board with Tribunals Ontario. But tenants actually have been growing pretty significantly, and you can't really tell because landlords are such a high amount on this chart. So I took the time to change it to the ratio of tenant claims to landlord claims. So basically, I just took the number of landlord claims and divided by the number of tenant claims. So landlord claims used to be 10x the number of tenant claims, and now it's dropped to about 7x. The interesting part is that the number of landlord claims hasn't really changed a ton. I think a lot of people make it sound like there's this huge increase in rent evictions and a huge increase in own use evictions and whatever. But as it stands, I mean, landlords really are using the Landlord and Tenant Board about the same, maybe a little bit elevated. Sorry, I don't know why this keeps jumping around on me here. Maybe a little bit elevated by comparison to past years, but maybe like you're 5%. And we hit a similar level in 2013 as an example. I'm just going to go through what we observed on all of the different types of applications. So non-payment of rent, which is the most common reason why a landlord would apply for an eviction, it's below pre-COVID levels. It's coming back, and you presumably would get back to those levels, but it is below those levels as it stands right now. Terminations for other reasons, which could be where a lot of those non-payment terminations are going, is just coming off of all-time highs. So it hit an all-time high last year, and it's just coming off there. Terminations to end a tenancy because of a failed settlement have increased substantially. And they're at an all-time high. The reason for this likely is because the board has been pushing more for mediation to try and keep the courts, balanced and get less volume through them so that they aren't as backed up. And so in that regard, failed settlements are more likely and therefore more likely to become a increasing number. The number of landlords applying for above guideline increases hit a record high. So in the province of Ontario, you have to apply if you want to get rents, if you want to increase your rents above the provincially mandated amount on units prior to 2018. Application to collect rent is on the decline. I would say that, my thought on this is that you're seeing people probably using this type of application less because they're actually going for an eviction if they are doing a non-payment of rent rather than doing just a rent collection application. Like most landlords have significantly little faith in the system, that they would rather just do an eviction than try and do a collection of rent. If we jump over to the tenant side, tenant claims are at an all-time high. And this is the sum of all of the different types of tenant claims. The one that has increased the most substantially is tenants asking for rent back for some sort of illegal thing that landlords did. So they either increased the rent too much, maybe they did something illegal or violated the contract in some way, lawn care, et cetera, things like that are sometimes reasons why this would happen. Tenant rights applications, pretty much the same as their long-term levels. rent reduction applications. So tenants basically going to the board to ask for a rent reduction. They obviously spiked a lot during the pandemic when we had that issue, and people were confused and they didn't know if tenants had to pay their rent or landlords had to pay their mortgages or whatever. It dropped off after that, and then it's sort of gotten back to where we would be at an all-time high if it wasn't for that pandemic period. And it seems to be like following a relative trend other than that outlier year, and we would be a little bit above that trend right now. Tenants, again, resisting termination. So the this was the steepest increase, but then it has sort of come off the top. But this is tenants basically rejecting a eviction for own use or for rent eviction, like if a landlord wants to take possession of a unit for rent eviction. So we've seen, pretty substantial increases there. Maintenance applications, kind of just a long-term, slow, steady uptrend. This is your total applications received. So we did hit an all-time high of number of applications received. This is the number of applications resolved, which also hit an all-time high, which after, it did get obviously quite bogged down during the pandemic there. So you're pulling forward a lot of that, and eventually will hopefully only need to be at this long-term level, but that backlog really it became its worst during the pandemic, but it was starting in 16, 17. Like you can speak to a lot of landlords during that period that started to experience those difficulties. The active cases at year end, so this was the backlog, let's call it, has obviously come down a little bit. It was pretty bad for the last couple of years. And so that about 55,000 cases in the last 2 years that were left over at the end of the year. So that was the backlog, and they're starting to work through that a little bit. So it does appear that, you might get some improvement, and really the Bill 60 policy does seem to be aimed at improving the speed in favor of landlords. Like, I don't think they're trying to pretend that that's not the case. I think that they're of the opinion that if you can improve the outcome for landlords, that it should get more supply delivered. Landlords should be more happy to be creating more supply, improving existing supply, maybe even reducing their rents, because they're not trying to make up for years of, or, whatever, 6 months of lost rents. And so I spend a lot of time studying the rental market, and a lot of people would assume that the primary reason for that is because I host Canada's #1 real estate podcast, which, that's my pitch. If you can have it in you to check it out for your new year, new me, when you all start listening to podcasts again in January, then we'd love to have you. It's a great show, and we do a lot of episodes just like this discussion twice a week. But the real reason why I'm actually interested in this is because I'm of the opinion that realtors are becoming rental agents. And I'm going to show you why. So if we look at the Toronto Real Estate Board, this is from an agent at my brokerage named Rob Garciglio. He's an awesome guy, and I would encourage you to check out his research. He does a YouTube channel, and he's on most social media platforms. The number of lease transactions on the Toronto MLS versus the number of sales transactions on the Toronto MLS, leases are, as of 2022, the majority of transactions that take place on the MLS. Yes, I know they're lower value, et cetera. But the point is, if you want to be doing deals, you would chase what is actually happening, and leases are, by and large, the majority of actual transactions happening on the MLS. 416, that crossover actually happened in 2018, which makes sense. Toronto, you've got a lot of tenants, you've got a lot more rental units, you're in a lot more of your urban markets. You see a lot more real estate professionals doing leasing. And for those of you who are not in Ontario or the GTA listening to this call, I know I try not to be a Toronto as the center of the universe kind of guy, but I do think that it's important to observe the trends that are happening in Ontario and the GTA, because they typically tend to lead. Things like, what happened with price declines is a good example in 2022. I think what happens from a policy perspective with multiplex, with upzoning, et cetera, has also been spreading across the country. And I would anticipate that this is going to be a similar trend that we'll start seeing across the country, especially with the amount of rental supply that's under construction right now. Like the vast majority, and I've covered this on other calls, so I won't get too into it, but the vast majority of supply that we're building in Canada right now is for rent. And so if we want to be part of transacting that, we have to pay attention to what's happening there as real estate professionals. A good hint on like whether or not the Canadian Real Estate Association is aware of this is the fact that they just hired the ex-CEO to be the CEO of realtor.ca. So I think you can see the direction that we're heading in this profession, trying to become, sort of a leasing platform. I would just encourage real estate professionals to really pay attention to that. We've had a lot of success with our agents at Valery, launching exceptionally good careers on leasing. it gives you kind of that slow and steady income that keeps the lights on, and you can still do sales transactions. Like, you don't have to be a one or the other type of agent, but a lot of brokers are having a lot of success doing it. We built an accelerator program for agents who want to succeed in leasing. In the 905, which I would say is probably a better indication of areas outside of the GTA, we just crossed over, or so, like, sorry, if you're looking for a better comp for like areas maybe like in a different province or whatever, we just crossed over where agents are starting to do more leases than sales. But the 905 is very much homeowner dominated. It's, it's suburban. Historically wouldn't see a lot of leases, but we are seeing it actually be more of the transactions. The other piece is that we also have a record number of units available for a lease. And so we're in basically what you would call a tenant's market. And I think we're in a tenant's market in most of the country because you have this record rental supply coming online. You have this opportunity where tenants can go and get cheaper rents if they're exiting a unit or whatever. And I think that, again, this creates a lot of opportunity for real estate professionals and especially teams who need to keep a lot of agents busy. This is a great way to do it. And it's a very good way to produce income at scale and get your reps in of doing transactions over and over. Like, if you really want a good way to replicate systems repeatedly so that you can become exceptionally good at the process of realtoring, a lease is a very good way to do that. They're 2-week to like 1 month sales cycles rather than like 6-month sales cycles. Total leases as a percentage of total sales. So we're now at the point where you're doing, in the 416, you're doing about 2.7x number of leases to sales. If you look at your inventory on the MLS, and this is an interesting thing that I've observed, is like, we're starting to see a little bit of like almost like a scarcity happening on certain types of listings in the GTA. You're starting to see a lot of sellers capitulate and move into renting properties out. And I'm sure you're dealing with this in other places across the country where you're getting a lot of that new supply being delivered, is people are taking possession of units. Maybe the units aren't worth what they hoped that they were worth. And so they're going to rent them out. It's like, do I want to lose money fast? Do I want to lose $100,000 today? Or do I want to lose $1,000 a month for the next 10 years? And most people seem to be choosing that lose money slow route, or more people seem to be choosing that lose money slow route, as we're starting to see a bunch of would-be sellers actually move their units onto the rental market and become landlords, even if they didn't originally intend to.
Here, I've got somebody asking, are you recommending that realtors represent tenants or the landlords?
Both. I mean, I think just getting involved in real estate transactions or rental transactions as a realtor is something that I would advise people to do. If you know property owners, I think that landlords is a great one. I think if you, this is very much a regulatory thing. Like, I think in BC, you have to have your property manager's certificate to do this. So like, it's not something that I can say is scalable across the country, but I think that a tenant lead is pretty easy to attract. We use systems like Facebook Marketplace, Kijiji, et cetera, to originate leads. And we take those leads and show them properties that are available in the MLS. If you have sellers who have units available for rent, or even property managers, like we have a lot of property managers coming to us in the GTA who are saying, look, like the quality of tenants that we're getting off the MLS isn't great, or isn't what we want. Would you put these properties on the MLS? And so we've now been representing a lot of property managers in the GTA for rental transactions. So I would say both is really the answer to the question. Yeah.
And circling back to Bill 60, somebody is saying, where can I see Bill 60? I have no idea what's in it. I haven't seen where that's been publicly available, like just by Googling it, but have you seen that anywhere online?
Yeah. If you Google Bill 60, you'll get you can just like see it. I also just did a video on it on my YouTube channel. If you just search like Google Daniel Foch YouTube, you should be able to find that as well. And I just like went through it for about 20 minutes. Any other questions?
That's good for now.
Okay. So the reason why the full rental part of the equation matters to me, and why I spend so much time researching this, is because renting really does matter a lot to homeownership. When renting and owning a house are interchangeable, like if we think about just the actual good that you're consuming, you need shelter, right? So you can either get shelter plus a savings vehicle, maybe an investment vehicle in the form of homeownership, or you can get just shelter that you pay a monthly fee for in the form of rent. And the spread between those two things, which you can see in the bottom right-hand corner here, it plays a big role in the way that housing markets behave, which I'm going to show you in a second. So Toronto rents were falling, house prices were falling as well, but the gap between rents and house prices, I'm going to zoom in on this chart in the bottom right-hand corner in a second. But the one thing that we are seeing is that Toronto rents seem to be stabilizing a little bit, and we'll see how long that lasts. But I think a lot of it is due to the fact that Toronto just hit a record pre-COVID office occupancy level, where basically we're back, or we're now at 82% of pre-COVID office occupancy, with the peak day of Wednesday at 91%. But if you go back to this chart where you can see the spread of buying compared to renting a 2-bedroom condo in Toronto, the cost of owning that unit is $3,600 a month. And I understand that owning real estate, or owning versus renting, is more nuanced than just a monthly payment. But for the purposes of this exercise, the monthly mortgage payment on a medium price condo would be $3,600 a month, whereas the rent on that same condo would be about $2,800 a month. And historically, you can see that the average rent and mortgage payment tended to trade in tandem pretty reliably. So the only difference between you buying or renting that unit was whether or not you could save a down payment. Now, because we have the mortgage payment that's so substantially higher than the average monthly rent, in a lot of markets in Canada, and I'm going to go through quite a few different markets in Canada, that spread improves the financial incentive for somebody to rent rather than own that condo, which means that if renting is significantly cheaper than owning, which is going to continue to become in many markets across Canada because we have record housing supply, this will disincentivize people from entering the market. It's not to say that this is like a long-term bear case for real estate. It's just something that's a factor that's worth being aware of. And it's really easy to see how this plays out in different markets across Canada. So if we look at a similar spread, Montreal has almost the highest spread that it's ever had. And that yellow there is just for comparison, the relative size of the spread by comparison to Toronto versus Montreal. Montreal is very much a renter city, right? It's culturally a thing in Montreal and almost very European in that way, where they are more comfortable renting in urban areas. And so Montreal is a good example of a market where you have high rentership because that spread has been that way for a little while. And it's always been a little bit higher, not a ton, but a little bit higher. Go to a city like Vancouver, it's very much the same thing. A lot of young people rent. Vancouver and Toronto are very similar. You jump over to a market like Calgary, where the spread is much tighter. And as a landlord, you're competing for tenants with homeownership, because in many cases, your tenant can afford to buy a house. Edmonton would be very similar, where the monthly cost of renting versus buying is very close. And so these observations, actually, even if you want to use an Ontario example, Ottawa, I think in the last video, or the 2 months ago, I showed how like Ottawa's market was kind of stabilizing a little bit better than some of the other markets. And a lot of that is because it closed this spread substantially enough that the economic incentive for people to move from the rental market into this purchase market made sense. And so people are re-entering the purchase market. Toronto, Vancouver, and Montreal don't really have that. And so it's been a bit of a headwind for their recovery, because people are happy continuing to rent by comparison to owning if the numbers make more sense. Winnipeg would be another example of a market where the spread is pretty close, and that market behaves like a market that's affordable, that's growing, that people can afford to buy houses. So they're transacting houses. They're not staying in rental instead of deciding to buy. This is why renting and rents really matter to me. What you'll notice is, based on the charts that I just showed you, the ones that have the closest spreads tend to be the ones that are right now in sellers market, so where there's a lot of demand for real estate. And the ones that have the biggest gaps tend to be closer to buyers markets, where they have an oversupply and not a lot of demand. Why would they have not a lot of demand? Because all of your buyers are choosing to rent because the economics of owning don't make sense. I hope that clarifies why I consider renting to be such an important piece of the discussion. Now, any questions on that section, Courtney, and then I can move over to the mortgage. I think you're seeing a lot of innovative homeownership methods evolve, like similar to what the question mentioned. There's rent to own. I think rent to own is a bit like stigmatized. So, newer versions of it or different names for it. But, there's programs like Cedar. Like we had our event, our Innovating in Homeownership event in October. And we had Key. Key is like a co-ownership program. Similar. It's like a better than rent to own kind of program where you get a little bit of investment. Cedar, which allows you to do leasehold. So they actually buy the real estate and then you lease the land off of them and you own the house. There's a handful of different innovative ways. Lotley, I think, is another one. Arboro. So I think that there's a lot of like innovations. I think a lot of these like rent to own concepts are sort of wrapped in prop tech now, but I think that you are seeing that. And I think that the fact that they're becoming super common is an indication that yes, the answer to that question is yes, it is happening, and it is part of the cycle for sure. All right, let's jump to the mortgage market here. So Canada's outstanding residential mortgage debt is about 75% of GDP at the moment. CMHC recently put out their fall mortgage report. This chart, I always love this chart when they put it out. So this is the chart that, most interestingly shows the trap that a lot of borrowers got into in 2022. So this pink line that you can see here is all of your borrowers. Can you see my cursor? Yeah. It's all of you. Okay, perfect. Yeah. Oh, it's all of your borrowers who piled into the variable rate mortgages during the pandemic right before rates went up because the fixed rates started to rise, the bond yield started to rise and price your fixed rates too high, and then people were going into the variable to try and collect some extra buying power. And then you saw obviously that big drop, rates went up. Everybody started taking your 3-year fixed, which is the red line here. So in your 3-year fixed kind of took. And during that period of time, I want you to think of like as a real estate professional, if you were advising people to take the 3-year fixed, or you're talking to clients and they were taking the 3-year fixed. Why were they doing that? They were doing that because they thought rates were going to come down in 3 years, or rates would be lower in 3 years, but they didn't know when. They didn't want to, or maybe the 2-year was a little bit too expensive or whatever. So you saw a period of time where that 3-year fixed was the most popular mortgage product. So this chart shows you what consumers are communicating about their expectations on interest rates. We saw a little bit of a time in Q1 of this year where variable rates actually surpassed your 3-year fixed, which would tell me that borrowers actually thought rates were going to come down faster, sooner. And that it now looks like borrowers have sort of taken a step back and said, maybe that's not true anymore, which is interesting. And a lot of this could be pricing. So it's obviously not purely a forecasting exercise. But your 3-year fix now is the most popular mortgage product again, and your variable has sort of dropped off. So consumers do think that, assuming if you set aside the pricing, which again, I think it's a piece of the puzzle, but I don't know if it's the entire piece of the puzzle. Consumers are indicating that they think rates are going to fall, but maybe not as fast as they originally thought, or they thought a couple of quarters ago. On that note, I put this chart out in the last report, but basically this is sort of like a consensus report on what most economists think is going to happen with rates. They'll probably fall a little bit further, and then they'll start to grind up towards the end of next year based on the government spending a ton of money, right? And fiscal dominance. Like the Bank of Canada can't even really game the curve of the inflation curve in the economy, because the government will be spending so much money that it should be creating inflation, and that will require, plus they're going to be borrowing a ton of money, and so the bond investors can kind of they have a little bit more freedom to charge higher rates. Your big 6 banks in Canada, who I always pay attention to because they're the ones who fund our deals and basically determine what's happening in the market, all have a similar consensus. So I would just watch this and see if it changes. I would imagine it probably will if any economic data changes, but as it stands, we had a pretty strong employment print last month, which I'll get into because there's mixed reviews on that. Inflation's at 2.2, which I'll get into. Big 6 banks have been increasing their market share as a result of a lot of what's happening. There's a couple of interesting observations here from CMHC's report. So the big 6 banks are growing as a percentage of the total market. They now have 75% of outstanding mortgages and 58.6% of new mortgages in Q1. A huge reason for this is this line right here on the insured and uninsured renewals. So I'm sure you've been hearing from like professionals in the space, if you talk to mortgage professionals, that it's really hard to beat the banks on renewals right now. The banks are basically doing everything they can to win these because it's the cheapest way to get a customer, right? The customer costs you nothing. They're already a customer. And so they're very competitive on renewals. I think that's part of it. I also think the other part of it is that a lot of banks or a lot of borrowers are trapped, to be honest. And like, if I got a mortgage during the pandemic at 2% and nothing else changed in my credit file, and I had to go get the same mortgage file at 4%, and when I got it at 2%, I was maximizing my borrowing power, then I can't requalify for that. Like, I couldn't qualify for that mortgage at 4%. And so even without the stress test between borrowers, and even if I went to go and switch from RBC to BMO, I probably am going to have a hard time. And so there are many borrowers who are actually trapped with their existing lenders, and they have to check the renewal box. And so the share of mortgages that it are where people are just checking that renewal box rather than shopping the renewals is basically the highest it's ever been. And the banks are obviously loving this. The banks are going to be the ones who win as a result of this policy or this trend. But yeah, you've got your same lender renewals are up about 2x, and your insured lender renewals are up about 50%. So 50% and 100%. Delinquency rates from CMHC's mortgage report. Chartered banks delinquency rates still rising, but obviously from a pretty low level. But they are still grinding up. The interesting part is that your mix and non-bank lenders are actually trending down for the first time in years. And I think that it begs the question, right? Is the pain in your B and C market already gone? Like, are all of your high leverage or high rate, higher risk borrowers, are they like, has all the pain already happened for them? And now we're moving on to the pain in the chartered banks, which would tell me that, you kind of getting closer to actually getting to the end of this, seeing the light at the end of the tunnel. I don't know, honestly. And I really I'm going to spend quite a bit more time researching this on just looking at different banks' books, different lenders' books to try and get an understanding. I think we will probably know, we'll probably know shortly based on like within another quarter if that trend holds and you keep seeing a reduction in delinquencies on private lenders and other non-bank lenders. I mean, that would maybe tell me that we are getting closer to the pain sort of stopping. On the power of sale side, I would say that it doesn't seem to be slowing that much, but your power of sales would probably lag your delinquencies by 90 days because that's typically, you have your 90-day delinquency rate here, and then you have typically how long it would take for your power of sales to actually take place. So I think we'll see. Delinquency rates for all borrowers is mostly unchanged. The only type that I would say is growing meaningfully is your line of credits, and then you've got your HELOC and mortgage. Actually, I think the delinquency rate's basically unchanged. It actually fell, I think, slightly. Like, I wouldn't call it a fall. It was like 0.5% or something. Delinquency rates are much lower for people who hold mortgages, but they are growing for people who hold mortgages, growing at a faster rate for people who hold mortgages. So I think usually you see your people without assets. So like consumers without a mortgage, tenants typically who don't have assets to burn through, savings, et cetera, houses where they can take from a line of credit. They will go delinquent on credit products first, and then your homeowners will second. So again, it could be that, again, we're kind of shifting from it could be a really good thing or it could be a bad thing, right? You could same as kind of like the end of the private lenders thing. It's like, is the shift from sort of the obvious lenders and borrowers who would go delinquent to the less obvious, is that shift a positive thing or a negative thing? It really depends on if this becomes like a systemically impactful challenge for those larger lenders and higher quality borrowers. Okay, jump over to the job market. Yeah, nothing. They are going to when they issue a bunch of bonds to fund their record deficits next year. So I guess just time is stopping them at this moment. Is that it? All right, let's jump to the job market here quickly. So I try and cover unemployment or StatsCan's labor force survey and inflation every month when we do these calls. Unemployment rate fell. It's down 20 basis points. I'm not I'm just the messenger here, right? So I think a lot of people don't trust this data, but it is what it is. For those people who feel that way, I'll give you the sort of the kind of truth of it. The employment rate increased. So your employment rate rose in October, and it was primarily driven by part-time work. But we are still up on a year-over-year basis, up 199,000 in full-time and 101,000 jobs in part-time. So again, is this something that I'm getting excited about? Probably not. Do I think the Bank of Canada cares that our employment level or like the number of jobs went up? Probably not if they're all part-time. So I don't know if this last month's employment really mattered a ton, to tell you the truth. The composition of like whether or not a lot of these part-time jobs are people who are already working other jobs would be a question for me. We don't track that in Canada anymore, but they used to track it they track it in the US, and it's sort of at a record level of people who are working more than one job because they need money to make ends meet. Youth employment started to look a little bit more promising. It actually fell. The youth unemployment rate fell for the first time since February. I've been really concerned about youth unemployment because I think that, when you have high youth unemployment, you have basically a group of young people who are have lost faith in the country and the economy, and they feel left out, and you can't. It's very hard to proceed when you have young people who don't have hope. But I think for our industry, it also matters because your young people are your future buyers of real estate, and if they don't have jobs, it's going to be very difficult for them to participate in the housing market. And so, again, I wouldn't call 1 month the beginning or end of a trend. So, but I'm curious to see if this continues. On a sector basis, wholesale and retail trade was the biggest jump. You usually see that happen towards this time of the year, October, November, December, heading into the Christmas season. I think like jobs reports are kind of tough to use for the next couple of months because of like part-time Christmas hiring and then also seasonal layoffs for the construction sector. We did see another loss in the construction sector, and now the construction sector is basically at, I think, negative 40,000 jobs this year, which is not good. Obviously, a knock-on effect of sort of the ailing construction sector in Ontario, where a lot of these pre-condo projects are finishing. On a province by province basis, Ontario, New Brunswick, and Alberta sort of jockeying for first position on who has the highest unemployment rate in the country. Second highest unemployment rate in the country. Then you have your sort of PEI and Newfoundland. You do have obviously in Nunavut a higher rate as well, but not typically used in the provincial comparisons. The interesting thing that I don't know why StatCan included this, because I don't know if it's part of the labor force survey, but they put this thing out that shows the financial insecurity of Canadians. And it shows that over 1 in 4 Canadians live in a household experiencing financial difficulties. 27.7% of Canadians aged 15 or older were living in a household that found it difficult to meet its financial needs in terms of transportation, housing, food, clothing, or other necessary expenses. It's a downward trend since October of 2022. But still pretty scary to me that that's like that a quarter of the Canadian population would define themselves in that position. And the interesting part is if you look at this kind of on a chart so it shows your unemployment rate. It's a scatter plot of your unemployment rate and then the portion of the households experiencing that. The 4 highest are all in Ontario. So we have Oshawa at the highest, which obviously Oshawa has been massively impacted by your layoffs in the auto sector. And then you've got Kitchener, Waterloo, Cambridge, Barrie, and Toronto. Talk about inflation. The consumer price index was up. So we're up at 2.2%, or sorry, it's up on a year over year basis, but it's down on the level. So we're seeing disinflation, not deflation. Deflation isn't when prices go down, but disinflation. So inflation is slowing. Again, maybe a data point that a lot of people don't believe, but when you go out and say, oh, groceries are way more expensive than this time last year, that is inflation. It just means that they're growing at a slower rate. Prices are still going up. They're just going up more slowly. We saw a large year-over-year decline in gasoline prices, which skewed the CPI down a little bit. If you do CPI excluding gasoline, it's still pretty high. And this is where when you kind of want to look at things like the Bank of Canada's core CPI. That's what the Bank of Canada would pay probably the most attention to. It's still pretty sticky. It's still at about like 3%. So I think that this is why you're starting to hear the Bank of Canada saying that they might be done with the cuts, because it doesn't really feel like we have the inflation thing under control. Not to say it's out of control, but it's not like they're not perfectly in the channel that they need to be. And I think there's a lot of question marks with the trade war, potential cost push inflation from those factors. I do think that trade war will probably end up being net deflationary based on the current setup. Like it's going to be very bad for our economy and probably will be. I would be surprised if it had a positive or an inflationary outcome. I would consider that a positive outcome, but I think the Bank of Canada obviously just wants to wait and see. Food and fuel prices are down. Gasoline prices have been declining on a year-over-year basis and for the last several months. If you look at a province by province basis, it's CPI has risen in only a couple of provinces. I think Manitoba, and I'll get to that. It's interesting, actually. A lot of that came from property tax, which is the first time I've seen StatCan use property taxes. But yeah, we just see Manitoba and BC. Basically, on the chart where the dark blue line is bigger than the light blue line, that's where they saw an increase. Everywhere else saw a decrease, or Newfoundland and Labrador was basically unchanged. It's interesting, they observed property taxes and they showed this huge increase in property taxes in Manitoba. Everywhere else saw a relative decrease in property taxes except Nova Scotia and British Columbia. Again, not a huge part of your CPI, but it is part of your housing costs. Any questions before I move on to the housing market? All right. The housing market charts, I always like to cover these. These come from RBC. I think there's some BMO in here as well. It just shows the number of units that are transacting. To me, this looks like a normal market, right? You can see that during the pandemic, that does not look like a normal market at all. For those of you who remember BC's frenzied market in 2016 and Ontario's frenzied market in 2017, you can see those above the line here as well. If you draw that red line, like there are some big fluctuations up and down. You have 2008, you have the recovery from 2008, but relatively, like, we're back in what I would call a normal market, and this is a good thing. Doesn't mean we're going to recover anytime soon, but it just means that we're like, this is what you should probably get used to. Maybe see a little bit more sales, but I would say at a national level, I don't think we're going to get much higher than where we are. Sales to new listings ratio, almost perfectly on a balanced market, just slightly in favor of sellers at a national level. Again, I showed you the chart on a market by market basis. It really varies. I think the market has tended to push a little bit in favor of sellers over the last little bit, even in the markets that would have favored buyers before. But generally, the easiest way to think about this is in affordable markets where people can afford to buy houses, you're in a seller's market. In unaffordable markets, we're in a buyer's market. House prices have been trending down. Basically, we haven't seen an increase in prices in like almost 2 years at this point, since 2024. Again, this varies on a market by market basis, and I'll show you a really interesting chart on that because that's at a national level. But if you actually look at different provinces, only one province has prices that are falling right now, and it's Ontario. The house price momentum on 3-month, 6-month, and 12-month are all below zero, but relatively close to zero. This shows us that basically our prices continuing to grind down. We're down about 18% off a peak at the national level, and that's using the HPI. For those of you who prefer to use the average price, it's a similar 15 to 18%, depending on if you're using adjusted or seasonally adjusted or not. This is actual. So this is the chart I mentioned that I've always find interesting. So, and this to me really just shows you how much Ontario skews the national average. So this shows you price increases or price changes in every market across Canada from October to October of last year. And house prices only fell in Ontario. Every other province saw an increase in house prices, and not small increases in house prices. Like Quebec over 8%, most other markets around or over 4%. BC was really the only disappointment there with just at 1%, but still growing. Ontario, with a drop of over 5%, was able to pull the entire national average down so that it was at -1%. So this shows you, again, when I talk about Toronto and Ontario, it's not to be a Tony Toronto center of the universe kind of guy. It's just to illustrate that it plays a massive role, and typically with Canadian economics, as goes Toronto, so goes the rest of the country. Unfortunately, right? It is just like it's just how it works. One last chart, and then I'll get to questions. The number of enrollments for international students in post-secondary programs, Canada has the largest drop in 36% decrease in bachelor's and 35% decrease in master's. So we've seen a huge decrease in international student enrollment. I've covered that in the last presentation, so I won't go too deep into it. I might do another update next time StatCan puts out their data, but I'm finished early this time, so we got a little bit of extra time for questions.